Have you ever heard that the ultra wealthy love investing in stocks, so you should too? What if I told you this is largely a myth? Welcome back to Escaping the Race. Today we're pulling back the curtains on how the ultra wealthy really use stocks and why their strategies are worlds apart from the average investor. And spoiler alert, learning every candle wick or chart pattern won't make you rich, but it might be as effective as learning to play blackjack. The myth that stocks are the ultimate path to wealth often comes from the misconception of how the ultra wealthy actually operate. Yes, they do invest in stocks, but not in the way that most people imagine. For them, stocks are a financial tool, not the final goal. Before we dive deeper, let's first take a look at who actually owns the stock market. According to Federal Reserve data, the top 1% of Americans control more than 50% of the stock market's value, while the bottom 90% of Americans control less than 10% of its value. If you've ever felt like you're playing a different game, it's because you are. To understand how the ultra wealthy diverge from everyday investors, let's first take a look at the three most common ways that regular people invest in the stock market. Method number one is buying and holding investing. You buy shares of a company that you believe in, and you hold them over time. Gains come from appreciation and possibly dividends. It's most suitable for those who believe in certain companies and want to benefit from those companies' growth over the years. Method number two is active trading. Traders seek to profit from short-term price movements, but this requires a lot of time, risk tolerance, and advanced market knowledge. Method number three is index investing. You invest in index funds or ETFs that track major market indices, such as the S&P 500. This strategy is known for its low cost but broad diversification, often outperforming most actively managed funds. For most people, these strategies rely on patience and compound growth over time, not a quick flip. But the ultra wealthy, they have an entirely different playbook. Here's the reality. The ultra wealthy don't invest in stocks for wild returns or quick flips. Instead, they use stocks as leverage, an advanced tool for maintaining and strategically managing their wealth. Let's break it down. Rather than selling and triggering capital gains taxes, they often borrow against their portfolio at low interest rates. A billionaire with $100 million in stocks might secure a $50 million loan at just a 2 to 3% interest rate using their portfolio as collateral. They can then spend that money however they want, tax-free, because it's not considered an income. Meanwhile, those stocks stay invested, often growing at a rate of 7 to 10% per year. And the interest that they pay on their loan may even be considered tax-deductible, further optimizing this strategy. By not selling, they defer their taxes indefinitely. When extra liquidity is needed, they strategically offset their gains with losses from other assets, such as real estate, something most regular folks can't easily replicate. For them, stocks are about steady returns or dividends in a diversified, high-value portfolio. Think of it like trying to protect a massive fortune rather than trying to aggressively grow a small one. Many wealthy individuals hold significant shares in companies that they control or influence. Their stock investments are tied to their business interests, not just passive income. Think of Elon Musk's control over Tesla. While he doesn't own the company outright, he does own over 20% of its shares, making him the majority shareholder and granting him significant influence over the direction of the company. The takeaway? The stock market isn't a one-size-fits-all wealth generator. For everyday investors, stocks can still be part of a solid long-term strategy, but they aren't going to magically turn you into Warren Buffett. Blindly copying the strategies of the ultra-wealthy is misleading because their goals, resources, and tools are fundamentally different. It's a bit like trying to copy a pro chef's recipe without the ingredients or the kitchen equipment. It's bound to be frustrating and disappointing. Instead of chasing myths, build a realistic, diversified plan aligned to your own resources, risk tolerance, and financial objectives. Let's address some of the biggest misconceptions. The rich get richer by picking winning stock. In truth, much of the ultra-wealthy's net worth comes from founding and owning businesses, real estate, or inheritance, not from stock picking. If it's good enough for them, it's good enough for me. The ultra wealthy don't rely on stocks for growth. Instead, they use them as a strategic asset to leverage, influence, and preserve their wealth. You can replicate their returns. Without access to private details, insider knowledge, and billions in collateral, your approach to stocks will naturally differ. Keep in mind that 80% of professional stock pickers, teams of Ivy League graduates working tirelessly to analyze the market, consistently underperform simple, low-cost index funds. No matter how confident or exceptional you may be, it's unrealistic to expect results comparable to Warren Buffett, Jeff Bezos, or high-level politicians such as Mitch McConnell or Nancy Pelosi, who operate with insider information and resources that are simply out of reach for the average investor. If you're not ultra wealthy, here's how you can invest in a more effective and grounded way. Focus on long-term growth. Invest in broad, low-risk index funds that ride the market's overall growth. Remember, while there's no such thing as a sure thing, the most effective strategies for passive investors are often low-risk, slow-burning strategies that build wealth over decades, not years. Diversify beyond stocks. Consider other asset classes such as real estate, bonds, or small business investments that fit your goals, involvement, and risk tolerance. Avoid over-leverage. Borrowing against your portfolio may sound appealing, but it can be very risky without having a massive safety net. Lastly, stay educated. Understand what you're investing in and why. Don't fall for get-rich-quick schemes, sales pitches, or disingenuous information. Always be sure to do your own research and decide for yourself what strategies best align with your goals and comfort levels. At the end of the day, learning every chart pattern is kind of like trying to perfect your blackjack strategy. You can improve your odds, but the house, or the market, still has an edge. Sure, some people get lucky, but consistently beating the market is a whole different challenge. According to studies, your odds of outperforming the broad market long-term are less than 20%. Meanwhile, a solid blackjack strategy could net you a win rate of up to 44%. The takeaway? If professionals struggle to outperform simple indices, imagine how difficult it is for everyday investors unless you treat stocks as part of a slow, steady plan rather than a get-rich-quick scheme. But that doesn't mean that stocks are useless. Used wisely, they can be a fantastic way to build wealth over decades. Just go in with your eyes open and use them as a piece of your overall strategy, and don't bet your life savings on every new hot stock you see trending. The ultra-wealthy may invest in stocks, but they're playing by completely different rules in a VIP lounge that we don't have access to. But the good news? You don't need to join their club in order to achieve financial success. If this video helped you rethink your strategy, be sure to smash that like button, share this video with a friend, and definitely subscribe for more honest insights. Let's keep cutting through the noise and building real, lasting wealth together.